All right, hello and welcome. We're going to work on the second video for Chapter 10, Property, Plant, and Equipment. And we spent the first one doing interest capitalization. Let's just recap what we know about interest capitalization. So to capitalize is to add to an asset. So you're debiting an asset account. The opposite of that is to expense, which you're debiting an expense account. So interest capitalization, you have a construction loan and constructing a building. So we're going to have the qualifying asset. It's going to be a building that you're building. You got a capitalization period, and you have to figure out the amount to capitalize. So it is the lower of the actual interest cost or the avoidable interest cost. So let's do two little shorter problems. That first problem had a 2-year kind of window. So let's do this problem of interest capitalization. So let's say we know the following information. We have the construction period is from January 1 to December 31st. It's for 12 months. And the required payments are going to be $500,000 and then $600,000 and then $750,000 and then $1 million. So it looks like the total is going to be $2,850,000. That's basically given, right? So then we've taken out a construction loan at the beginning of the year for $2.5 million, and we need to know the interest rate on this. So the interest rate on the loans we'll figure out in just a minute. I think I've given it. I think I erased this. So the interest rate on the construction loan is going to be 7%. 7%. The notes payable is going to be 8%. The bonds payable is going to be 10%. All right, so we're missing that information. And we have the construction loan is $2.5 million. The notes payable is $2 million at 8%. And the $1.5 million bonds payable is 10%. All right, so this is our given information. Now, let me ask you, we could ask this as a problem like, hey, what is the weighted average accumulated expenditures? What is the avoidable interest? What's the actual interest? So you can calculate it out into steps, but here we're going to calculate, these and just kind of go back and fill in the blank. Now, one of the things I would do here, I would calculate what is the average interest rate. So let's do this one here. If we take the 2 million times the 8%, we're going to get 160,000. And if we take the 1.5 million times 10%, we're going to get 150,000. So our total interest would be 310,000. So 310,000, let's calculate the rate here. 310,000 divided by the 3.5 million. It's going to be in between the 8 and the 10%. So it looks like it is 8.85 or something like that, 8.86. So this, when we need the number, this is our weighted average interest cost for the other loans. All right, so that's given information. So the first thing we're going to do is calculate the weighted average accumulated expenditures, and then we'll use that number to calculate avoidable interest, and then we'll calculate actual interest. So let's scroll on down and let's work on the weighted average accumulated expenditures. All right, so I've just kind of set this up just to be a little quicker. So our expenditures are $500,000. It's due on January 1st, then $600,000 on April 1st, and then $750,000. And then on December 1st, it's $1 million. All right, so here's our expenditures. How many months do we have for the entire year? Well, January all the way through the end of the year is 12 months. If we're missing the first 3 months, so April 1st all the way through the end of the year is 9 months. September 1st is September, October, November, December. That's 4 months. And then December 1st, we only have 1 month. Now, if this were December 31st, we'd have 0 months and the average would be 0. So this is the kind of weighted average column. This is going to be the weighted average accumulated expenditures. So we'll take the 500,000 times 12 divided by 12. So it's going to be 500,000. We're going to take the 600,000 times 9 twelfths, 450. The 750,000 times 4 twelfths. I've built the formula based on 12, right? And then 1 million times 1 twelfth is 83,333. We're going to add this up and total 1,283,333. So what is this number? This is our weighted average accumulated expenditures. So we're going to drop in this number is our weighted average accumulated expenditures. That's our answer. That's our answer here in this problem. So what is our avoidable interest? Remember, we're going to take the avoidable interest and drop it in. What if we borrowed that money, right? What if we borrowed that money and we had to pay interest rate? Or what if we'd taken that amount and paid off debt with it? So we could have avoided, if we paid off debt, we could have avoided some amount of money, and that's the avoidable interest. Now, how much is our construction loan? Our construction loan was originally $2.5 million. So this more than covers the $1,283,000. So we're going to take just this number, $1,283,000, and then the other is going to be 0. The interest rate on the construction loan is 7%, and the interest rate on the other debt is 8.86. It's not going to matter because it's going to be 0. But we can calculate the interest expense to be $1,283,000 times 7%. We get something like $89,833. And then we can take 0 times the 8.6 or 8.86. Certainly that's going to be 0. So our avoidable interest is $89,833. So avoidable interest is this number right here. Now we're going to capitalize the smaller of the avoidable interest or the actual interest. Honestly, on these problems, I think the actual interest is always going to be larger than the avoidable interest. I don't know of an example where it would be the avoidable would be more than the actual. So generally, that's going to be the interest capitalized number. All right, so let's look at the actual interest. So how much is our construction loan? Well, our construction loan is $2,500,000. Our notes payable is $2 million, and our bonds payable is $1,500,000. The interest rates are given at 7%, 8%, and 10. And we're going to calculate the interest for the full year. $2,500,000 times 7% is $175,000, and then just multiply the other amounts times the interest rate. So 175, 160, and 150, and that totals $485,000. So our actual interest is $485,000. So what is our interest to be capitalized? Well, it's going to be the $89,000. So this is our capitalized interest. So we'd actually make an entry: debit, building, credit, cash, $89,833. So our building would have $2,850,000 plus another $89,833 as the amount of the building. That's our cost. All right, let's look at the second problem. Same kind of problem, just different numbers. Let's do our second problem where we have January 31st, and we have different dates, we have different amounts, and certainly we can add this up and figure out, well, this is a $3 million construction project. Construction period is January 1 through December 31st. The construction loan, once again, I think I got rid of the interest rates. The construction loan is going to be $1 million at 8%. And then the notes payable is going to be 9%. And the bonds payable is going to be 12%. All right, so one of the things we can do is we can calculate, what is the average amount over here. So let's calculate the average interest rate. So if we take the 9% times 750,000, and we take the 1.2 million times the 12%, and we add this up, then that means we'd have total interest of $211,500. Well, what kind of interest rate is that? That is 211 divided by 1.95 million. So it's going to be in between the 9 and the 12. It's going to be weighted more toward the 12 because it's 1.2 million rather than 750,000. So this is not a simple average. This is a weighted average. And we'll calculate this to be something like 10.85%. All right, so what are the weighted average accumulated expenditures? Well, let's drop in the expenditures that we know. It's going to be 1 million here. 1 million, and the date is January 31st. Watch, it's not the 1st. And then May 1st, that's going to be 800,000. And then August 31st is 700,000. And then December 31st is going to be 500,000. Okay, all that is just given. How many months do we have left? On January 31st, we have 11 months left. On May 1st, we're just missing the first 4 months. We include May all the way through December. That's 8 months. All right, so here, 8/31 is August 31st. So how many months do we have left? After August, we have September, October, November, December. We have 4 months. Be careful on that. It's easy to get tripped up. And then how many months after December 31st? Well, 0 months. So we're going to take 1 million times 11 divided by 12. We're going to take 800,000 times 8 divided by 12. So 533, we just copy it down. And we'll have 0. 500,000 times 0 over 12 is still going to be 0. So our weighted average accumulated expenditures are going to be something like 1,683,000. So the answer for weighted average accumulated expenditures is 1,683,333. So what's our avoidable interest? Well, it is the 1,683,000. Now the construction loan in this example is only $1 million. So we've got $1 million here in the construction loan. The interest rate on the construction loan is 8%. Now we need the other. We could have paid off that other amount of loans, and the weighted average of that would be 1,683,000 minus the 1 million. So we're talking about 683,000. The interest rate attached to the average of all that is 10.85. So we'll multiply 1 million times 8%, and then the 683,000 times 10.85. And we're going to end up with our avoidable interest of 154,115. This is avoidable interest. Avoidable interest. The last thing we do on this problem, I've got it all set up here for us, is we have the actual interest, 1 million times 8%, 750,000 times 9%, 1.2 million times 12%. That's all just given. Multiply and we get 291,500. So what is our avoidable interest? Our avoidable interest is 154,000. Our actual interest in this problem is 291,500. All right, so what do we do on this one? We have the avoidable interest is going to be the capitalized interest. The capitalized interest is going to be the $154,115. All right, we're going to do a couple more little small things in property, plant, and equipment chapter. So let's just knock them out, small little problems. Okay, let's look at this deferred payment for property, plant, and equipment. Let's say that we purchased equipment by signing a note for $500,000 for 5 years, a monthly payment for 5 years at 6%. What is the present value of this loan? Well, the present value, let's just calculate the present value. The rate is 0.06. Now, remember we're going to have to put in a periodic rate, so we got to divide by 12. The number of periods is 5 years times 12. That's 60 periods. I'm going to put in a negative 500 as my payment. My future value is 0, and the payments happen at the end of the period. So what do we have? The present value of the loan is $25,862.78. So that means we're going to make an entry. We're going to debit equipment, credit notes payable for $25,862.78. Okay. Now, what if you issue stock and you buy some type of equipment or whatever? So the rule is we're going to use either the fair value of the asset that we purchase or the fair value of the stock, whichever is the most objective. So let's do a little problem here. Land is appraised at $10,000, but we're issuing 2,000 shares. And the 2,000 shares have a par value of 2 and it has a fair value of 6. Let's say that it's traded on the open market. It's traded on the NASDAQ or whatever. Then we feel like we know the share price of the stock is more readily apparent. So therefore, we're going to use the 12,000. And then common stock is the par value of 2. And then the difference is a pick. Now, if the stock is for a company that does not have a market, it's a privately held company, then you might use the negotiated, you'd find some negotiated price. You would find, what's the appraisal value of the land. That might be more objective rather than what you think your own stock is worth without any market. All right, last little problem here is an exchange. We'll run through this real quickly. You can see the example. So non-monetary exchanges, here's what happens. If you exchange a truck for a new truck. So let's say that Roberts has a Ford truck that cost $40 and has accumulated depreciation. I misspelled accumulated depreciation here. Of $12,000. The fair value is $25,000. So it's on our books. Now watch, it's 40 minus 12. It's on our books at 28. It has a fair value of 25. We're swapping it for a new truck that has a new to Roberts. It's James' truck. It's 29,000 minus the 2. It's on James' book at 27. It has a fair value of 31. All right, so what if cash is paid and cash is received and there's commercial substance? Well, if you pay cash, then what you do, the Roberts is going to show the loss of $3,000. So they're buying the new truck for $31. They're getting rid of the old asset of $40. They're getting rid of the old accumulated depreciation of $12. And they're going to pay cash. So the fair value of 25 plus 6 gives them 31. So they say 31,000 is the Honda truck. They're giving up cash of 6 and they have a loss. Remember the loss because it's on their books at 28 and the fair value is 25. James would have cash received, so received cash of 6, buys the new truck of 25, that's the fair value. Gets rid of the old accumulated depreciation of 2, gets rid of the old cost of 29, and James would have a gain of 4,000. Where do we get that 4,000? Well, they received They have an asset on their books at 27. They receive 25 plus cash of 4. They receive 29. And it's on their books at 27. They gave up 27. And so they received cash. So their gain is 4,000. Now, if there's a out that says, look, if there's no commercial substance, if there's not a reason to do this except maybe for tax purposes, then Roberts goes ahead and recognizes a loss, but the gain for James is just rolled into the cost of the new truck. And the new truck for him would be the Ford. And you can see kind of so what happens is if there is only a small percentage of cash, then you don't recognize a gain. You only recognize the gain to the extent that there's a cash. If the monetary calculation is 25% or more of the fair value of the transaction, then it's monetary and you don't have to worry about if it is, you recognize only partial gains partial gains and the complete loss. In all cases, you'd recognize the complete loss. This is a good little problem just to know. I'm probably not going to ask you very much on this, but this is how you calculate it. Go back and look at this problem. If you need some more help on that, let me know and I can create a little problem where we have this. All right, thanks for watching the second video of Chapter 10.